The Dow Jones has crossed the 50,000 mark, but beneath the surface, the software sector is experiencing a tectonic meltdown. If you aren't watching the Japanese yen and the consumer price index data coming this week, you are trading blind.
It's Sunday, February 8th, 2026. This is Theta Fuse. Let's get into why this specific week is potentially the most dangerous of 2026.
Dangerous is a big word. I mean, it's a word that usually gets thrown around when markets are crashing, not when they're hitting these huge psychological milestones like Dow 50,000.
Yeah, right.
You look at the headlines this morning, and it's all a victory lap. You see confetti, champagne, the whole 9 yards. But you and I are looking at the same screens, and we are seeing something completely different.
I'm seeing a facade, a very expensive, very shiny facade. Dow 50K is, a great bumper sticker.
A great headline.
A great headline, but it masks the fact that we're flying directly into a hurricane with our radar systems turned off. We have to be very, very precise about this because the narrative out there is soft landing achieved.
Right. Mission accomplished.
Exactly. But the reality in the data, or more accurately, the lack of data, suggests we are standing on a trapdoor.
Okay, let's start right there with that lack of data idea, because that feels like the most immediate threat. Usually we sit down on a Sunday like this, and we have the non-farm payrolls number from Friday to just, completely dissect.
It's our North Star.
It's our North Star. It tells the entire global economy what's happening. Do people have jobs? Do they have money? Is the recession canceled again? But this past Friday, we got nothing.
Crickets. Just silence.
Yeah.
And this is a direct casualty of that government shutdown. It officially ended on February 3rd, but people forget you can't just flip a switch and turn the Bureau of Labor Statistics back on.
It's a huge operation.
It's a massive machine.
Yeah.
And that 5-day disruption, it broke the entire chain of custody for the data. The surveys couldn't be processed, the servers were dormant, the analysts were furloughed, so they had no choice. They just pushed the release to this coming Wednesday.
Which, on the surface, sounds like a minor administrative annoyance. But for the markets, it's a massive, massive issue.
It's a liquidity issue at its core. I mean, think about how the big algorithmic trading desks actually work.
The algos that run everything.
They run everything. Their models require inputs, they feed on data, and the biggest, most important input every month is that jobs report. When you remove that input from the equation, the algorithms don't just, guess.
No.
They widen their spreads, they pull back liquidity, they immediately reduce risk. So the fact that the market hit all-time highs on Friday, it happened in a total liquidity vacuum.
So it wasn't a real rally.
It was a rally based on the absence of bad news, not the presence of any actual good news.
It's just momentum. It's trading on momentum and hope, which feels dangerous. But we aren't completely blind, all right? We do have some of the precursor data that dropped last week.
We do.
And this is where that whole soft landing narrative, for me, it just starts to completely fall apart. We saw the ADP report, we saw the Joel test data, and frankly, the divergence between what the stock market is doing and what those reports said is.
Right.
It's frightening.
I mean, that gap. It's the widest divergence I've seen in this entire cycle. Let's just look at ADP first. The expectation was for private employers to add somewhere around 45 to 50,000 jobs.
A pretty low bar already.
A very low bar. And ADP came in at 22,000. That is a 50% miss, a clean miss. Now, I already know the counter argument. People always say it.
Oh, it's just ADP. It's not the government data.
Right. It's just a payroll processor. The methodology is different.
The correlation isn't always one-to-one. We get it.
It's not. It's not one-to-one. But the trend is the signal. And you have to respect the trend. When ADP collapses to 22,000, and at the exact same time,
job openings and labor turnover survey?
That number sinks to levels we have not seen since the absolute depths of the pandemic lockdowns in 2020. You have to stop ignoring the signal.
Yeah.
My favorite metric in the whole JOLTS report is the quit rate.
Because it's a confidence metric.
It's pure confidence. You don't quit your job unless you are absolutely sure you can get a better one, probably across the street for more money. And the quit rate didn't just dip, it's flatlined, it's gone.
So the velocity of the labor market has just frozen solid. People are hunkering down, they're staying put. That explains the low-hire part of the equation.
Right.
But for a really long time, the bull case has been this low-hire, low-fire dynamic. The idea that, okay, companies aren't hiring, but they're not firing people either. They're hoarding labor because they remember how incredibly hard it was to find people back in 2022.
They had PTSD from the hiring boom.
Exactly. But that dam is breaking now, isn't it?
Oh, that dam has burst. I mean, look at the Challenger, Gray, and Christmas report on layoffs. The January layoff announcements. They hit their highest level for the month of January since 2009.
2009.
I want to repeat that year, 2009. That was the great financial crisis. The world was ending. If companies are now announcing cuts at a velocity we haven't seen since the global financial system nearly collapsed, you cannot sit there and tell me the labor market is strong.
Okay, but here's the confusing part. Here's what I don't get. The economists, their consensus projection is for the unemployment rate to hold steady at 4.4% when we get the data on Wednesday.
Right.
They're expecting 70,000 jobs to be added. So how do you possibly reconcile layoff announcements at 2009 levels with a stable unemployment rate? It doesn't make sense.
It's what I call the severance lag. This is the technical nuance that traps retail investors every single time. It's a bull trap.
Explain that.
Okay, so if I fire you today in February, but I give you 3 months of severance pay, which is pretty common in tech and finance,
Right.
you don't file for unemployment benefits until May. You do not show up in that official U3 unemployment rate until the summer. So the Challenger report is the leading indicator. It's the flash of lightning.
And the unemployment rate is the thunder.
The unemployment rate is the thunder. It always comes later. We are seeing the lightning right now. The thunder is coming.
So we are walking into Wednesday with the entire market priced for a Goldilocks number. Not too hot, not too cold, but all the leading indicators are just screaming, recession! If that number on Wednesday misses, if it comes in at 0 or even negative.
Then the Dow 50,000 party is over. It ends, and it ends abruptly. But here's the twist. Here's what makes this time different. Usually, when the labor market finally cracks, the market rallies anyway.
Right. Bad news is good news.
The classic playbook, jobs are lost, so the Fed has to cut rates, the money printer turns back on, and risk assets fly. That has been the only playbook that's worked for 15 years.
It's the Fed put. The idea that Jerome Powell will always write in and save the market.
Exactly. But this time the Fed is in handcuffs. And this is precisely why this week is so incredibly dangerous. We have this macro storm of bad labor data colliding with what I'm calling the inflation wall.
Because we still have CPI.
We still had the consumer price index dropping on Friday.
So on Wednesday, we find out if people have jobs. And on Friday, we find out if they can still afford to eat.
That's a brutal way to put it, but it's completely accurate. The forecast for Friday is for a 0.3% month-over-month rise in prices.
And what does that annualize to?
That annualizes to nearly 4%. You cannot cut interest rates when inflation is running at 4% and the stock market is simultaneously at an all-time high. It is politically and economically impossible. Powell made this crystal clear last week. His exact words were that rate cuts are not coming anytime soon.
And the market just completely ignored him. The bond market heard him, yields stayed up, they listened. But the equity market just put its fingers in its ears and kept buying.
Complete denial.
And now there's this whole new variable in the Fed equation. Kevin Warsh.
The nomination of Kevin Warsh as the next Fed chair nominee is a massive, massive signal from Washington. This is not a dove. This is not a guy who's going to print money at the first sign of trouble.
He's a hawk.
He's a hawk. Warsh has a long history of criticizing the Fed for being too easy, for keeping rates too low for too long. He is a hard money guy. His nomination signals a complete regime change. It suggests that the entire era of ZRP's zero interest rate policy is gone and buried for good.
So Warsh Fed is going to be far less likely to bail out the stock market just because, Salesforce dropped 10%.
Not a chance. He'll see that as healthy.
Okay, so let's just summarize this macro picture before we zoom in on the sectors, because this is a lot. We have a delayed jobs report that is very likely to be ugly, but it's hiding behind that severance lag you talked about.
Correct.
We have sticky inflation that is preventing the Fed from cutting rates to fix that cracking labor market.
Right. They're trapped.
And we have a new, very hawkish Fed chair nominee waiting in the wings. That is a toxic brew.
It is a stagflationary brew. You have low growth from the jobs plus high prices from the CPI. That is the single worst possible environment for equities. And yet here we are at Dow 50K.
The cognitive dissonance is it's off the charts.
And nowhere is that dissonance louder. Nowhere is the pain more acute than in the software sector.
Let's pivot to that, because meltdown is not hyperbole here. We are seeing a divergence inside the tech sector that is honestly historic. On one side, you have the hardware and the infrastructure plays. They're holding up just fine.
Holding up great.
And on the other side, you have software as a service SaaS, and it is getting absolutely slaughtered. I'm looking at Salesforce. It's down 14% year-to-date. Workday, down 12%. These used to be the safest of the safe tech bets. The compounders.
They were the royalty of the cloud. That was the term. You bought them, you held them, and you got rich. The entire thesis was that data is the moat.
Right.
You can't leave Salesforce because all of your customer data is in there. The switching costs were just too high to even think about. But that thesis just died. Last week, it died. And it didn't die because of interest rates. It died because of AI.
And this is the cowork bombshell.
It is. We absolutely have to talk about what happened with Anthropic last week. They launched this product or demo called Cowork, and it completely changed the psychology of the market overnight. I mean, literally overnight.
How so? What was the shift?
For the last 2 years, investors have been worried about what we call first-order costs.
Okay.
The worry was that companies were spending too much money buying NVIDIA chips. The big complaint was, oh, Google's CapEx is too high. Microsoft is burning too much cash.
Right, the CapEx burn argument. We've talked about it 100 times.
Exactly. But Cowork triggered the second-order fear, the fear of complete replacement. Anthropic showed off an AI agent that doesn't just answer your questions, it does the work.
I saw the demo. It was eerie.
It's eerie. It logs into the software for you. It moves the mouse. It clicks the buttons. It updates the database. It manages the workflow. It's not a chatbot.
No, it's a digital employee.
It's a digital employee that costs pennies on the dollar compared to a human being. Now stop and think about the business model of Salesforce or Workday or ServiceNow. How do they actually make money?
They sell seats. It's a per user, per month subscription.
The entire seat-based economy. If you have a sales team of 100 people, you buy 100 Salesforce licenses at, say, $300 a pop every month.
Right.
But if an AI agent can do all the grunt work of updating the CRM, entering the data, managing the pipeline, maybe you don't need 100 salespeople anymore. Maybe you need 10 human supervisors and 90 AI agents.
And the thing is, AI agents don't need a user interface. They don't need a seat in the traditional sense. They just need API access.
Exactly. And that's where the pricing power completely collapses. If I can replace a human who uses a GUI, a graphical user interface, with an agent that just uses an API, the value proposition of that expensive SaaS platform just shrinks dramatically.
So the market suddenly woke up and realized, wait a minute, if the humans leave the workflow, the tool that was built for the humans becomes less valuable.
That's the panic. That is the falling knife scenario we're seeing. Investors are looking at these valuations, Salesforce still trading at 6, 7, 8 times revenue, and they're realizing that if the terminal growth rate is actually 0 or negative, those stocks are still incredibly expensive even after a 14% drop.
It's a value trap.
It's the ultimate value trap. A stock down 14% can still be massively overvalued if its entire business model is on the verge of becoming obsolete. We are seeing a fundamental repricing of terminal value.
Wow.
The market is asking, for the first time ever, will Salesforce even exist in its current form in 10 years? And for the first time, the answer isn't a guaranteed yes. That is why the big software ETF, the IGV, had its second worst drop since April of last year. It is a run on the bank, but the bank is the SaaS business model itself.
But there is one giant, glaring exception to this entire tech wreck. And it's the company that, ironically, everyone loves to hate, specifically for their spending habits.
No.
Alphabet, Google.
The Alphabet anomaly. This is, without a doubt, the most important signal in the market right now. In a week where the entire software sector melted down, Google is up 5% year-to-date.
Which makes it the best performing, magnificent 7 stock of 2026 so far.
By a mile. And they did the one thing that you are never, ever supposed to do in this environment. They announced a spending number that was absolutely eye-watering.
$185 billion. In capital expenditures. I had to read that number twice.
It's staggering.
The street was expecting, what, maybe $120 billion?
Maybe 120 on a high day. So this is a $65 billion surprise. Usually, if a CEO gets on a call and says, by the way, I'm spending an extra $65 billion this year, the stock tanks 15% instantly.
Instantly.
Sure.
But Google went up.
Google went up. Why? Because the market has finally figured out the difference between the landlord and the tenant.
Okay, break that analogy down for us.
Salesforce is a tenant. They rent infrastructure from Amazon or Microsoft or Google to build their app. Google is the landlord. They own the actual data centers. They own the fiber optic cables. They own the massive energy contracts. And crucially, they own the chips, their custom TPUs.
So when they spend money, they're not just burning it.
When Google spends $185 billion, they aren't burning cash. They are building the railroads of the entire AI century. They
Mhm.
are building the infrastructure that everyone else will have to pay rent on.
And the operational metrics they released really back that up. I was looking at the YouTube numbers. They said 700 million hours of podcasts are now watched on living room devices.
700 million hours, and it's up 75% year over year.
That's insane growth.
That is attention capture on a scale that is hard to comprehend. They own the eyeball time. And then you look at Gemini Enterprise.
8 million paid seats.
8 million paid seats in just 4 months.
I can't remember a faster ramp for any enterprise product ever.
It's unheard of. And it proves the point. It proves that while companies are looking to cancel their Salesforce seats, they are lining up to buy Gemini seats. Why? Because Gemini is the productivity engine. It's the electricity. Salesforce is just the lamp.
And you need electricity more than you need one specific lamp.
You have to have the electricity. So Google is winning the infrastructure war at the exact same moment that the software apps are losing the moat war.
So it's a massive rotation. It's a rotation of capital out of the application layer and down into the infrastructure layer. And this brings up that whole concept of vertical integration, which I think we really need to dive into, especially when it comes to the chips.
Absolutely.
But before we get super technical on the silicon, I just want to pause for a second. We've thrown a lot at you, the listener. We've got delayed jobs data, we've got inflation risks, we have software stocks just crashing.
It's a lot to process. I mean, the ground is literally shifting under your feet as we speak.
It is. So if you want to survive this volatility, you cannot just read the headlines. The headlines say Dow 50K. The reality is software crash. You need the deep dive. That is why you need to comment and subscribe to Theta Fuse. We are here every single week parsing the signal from all the noise.
And we really want to make this a two-way conversation. So here's the deal. Drop a stock symbol in the comments below, just the ticker. We'll go through them and we'll pick the best ones, the most controversial, the most confusing, the stocks you were terrified to hold or maybe really excited to buy, and we will do a deep dive analysis on them in our next episode. Tell us what's keeping you up at night.
Okay, so let's zoom out. Let's go way out to the global view. Because while Silicon Valley is having this existential crisis about AI agents, there is a geopolitical earthquake happening in Japan that could actually derail the U.S. markets faster than any software bug.
The Takaichi Trade. This is the sleeper list of the year, no question. Sanai Takaichi has just won a landslide victory in Japan, and she's become their first female premier.
Which is, a historic moment, socially and politically. But for the markets, what really matters is her economics philosophy. She is not a status quo politician.
Not at all. She is a true disciple of Abenomics, the policies of the late Shinzo Abe. But you could even say she is Abenomics on steroids. Her entire platform is built on aggressive stimulus, massive fiscal spending, and unending monetary easing. She literally wants to print money to force growth.
And the Japanese stock market, the Nikkei, absolutely loved it.
They loved it.
It ripped to an all-time high of 54,782.
Of course, equity markets always love free money. But the currency market hated it. And this is where the real danger lies for you, the U.S. listener. The yen is getting absolutely crushed.
What are the numbers on that?
It has lost 6% against the dollar just since October. And now, with Takaichi having this clear mandate to spend, you have currency strategists at major banks talking openly about the yen spiraling to 180 per dollar.
180. I mean, we haven't seen levels like that since 1986.
Yeah.
That's a devaluation that borders on a full-blown currency crisis. But explain the mechanics for us. Why does a cheap yen in Tokyo matter to a guy with a 401k in Chicago?
It matters because of something called the carry trade. The yen has been the funding currency of the entire world for decades now.
Okay.
Because interest rates in Japan have been zero for so long, global investors, we're talking big hedge funds, banks, everyone, they borrow money in yen. They pay almost zero interest on that loan. Then they take that yen, they convert it into dollars, and they use it to buy U.S. tech stocks or U.S. treasuries that pay 4 or 5% or something that grows 20%.
It's basically free leverage.
It is free money. It has fueled the asset bubble for years. But there is a catch. The catch is that you are short the yen. If the yen gets too volatile, or if the Bank of Japan is suddenly forced to intervene to stop the bleeding, the value of that loan you took out changes dramatically.
So it unwinds.
It unwinds violently. If the yen collapses too fast, it creates massive instability. It actually exports inflation to the U.S. A cheap yen makes Japanese goods cheaper, sure, but it makes the dollar stronger. A super strong dollar always breaks things. It crushes U.S. multinational earnings, and it absolutely destroys emerging markets that owe all their debt in dollars.
So Takaichi is basically lighting a fuse on the global currency markets just to save her own domestic economy.
She is choosing what's called fiscal dominance. She is sacrificing her country's currency to save her country's stock market. And she has a very specific target for all that money she's going to print: defense, AI, and chips.
And that brings us right back full circle to technology. She wants Japan to be a major player in the hardware game again. And this aligns perfectly with the other major trend we are tracking, what you've called the new IBM trend.
Right.
The big return of vertical integration.
This is maybe the most fascinating architectural shift in the tech industry. We are literally unwinding 40 years of established history.
I was reading one of our sources that made this great comparison to IBM back in the 1960s. And it's so true. Back then, if you bought a computer, you bought an IBM. And they made everything. They made the chip, the board, the box, the operating system, the software.
And they even sent the guy in the blue suit to your office to fix it when it broke. It was a monolith.
Yeah.
A total monolith. Then, in the 80s and 90s, the whole thing fragmented.
Right. Everyone picked a lane.
Everyone stayed in their lane. Microsoft did Windows, Intel did the chips, Dell made the box, Oracle did the database. It was the era of horizontal specialization.
But now, the hyperscalers, Amazon, Microsoft, Google, they're all looking at this and saying, to hell with specialization, we want to own it all again.
They want to own the whole stack, and it's because they are sick and tired of paying the NVIDIA tax.
That's a good way to put it.
NVIDIA has been the toll booth operator for this entire AI revolution. They have gross margins of 75%. Every single time Amazon or Microsoft buys an H100 GPU from NVIDIA, they are paying a massive, massive premium. And what's worse, they have to wait in line because supply is so limited.
So they're just deciding to build their own. They're cutting out the middleman. And this isn't just a slide deck presentation anymore. These chips are alive.
They are in production right now. Amazon did something very rare for them. They invited reporters to their chip lab in Austin recently. They're usually so secretive. And they showed off the Ultra server.
The Ultra server. I mean, it sounds like something out of a sci-fi movie.
It basically is. It's an absolute beast. It combines 64 of their custom Trainium AI chips with their custom Graviton CPUs.
Wow.
There is no NVIDIA involved. There's no Intel involved. It is pure Amazon silicon from top to bottom.
And the claim they made was pretty significant.
It was a bombshell.
Ah.
They said for training large language models, this setup offers a 60% price performance benefit over using NVIDIA GPUs.
60%. In the world of cloud computing, where your margins are measured in, like single basis points, a 60% advantage is an insurmountable moat.
It's game over. If AWS can sell you compute power 60% cheaper than a rival who's stuck using NVIDIA chips, that rival is dead. They can't compete.
It just forces the price of compute down for everyone.
Exactly. And Microsoft is doing the exact same thing. They've already deployed their Maya 200 chip into their own data centers. It is running Azure OpenAI workloads as we speak.
And then there's the rumor about Google. This one felt like a real cartel-busting move to me.
Oh, this is a shot across the bow. The report is that Google is in serious talks to start selling their TPUs, their tensor processing units, directly to Meta, directly to Facebook.
Which is huge, because Google has always kept its TPUs for itself. It was their secret weapon.
It was their in-house advantage. If Google starts selling its custom chips to other tech giants, they are directly competing with NVIDIA as a merchant silicon provider. It is a declaration of war. Look, the custom AI chip market is predicted to grow to $122 billion by 2033. This is not a side hustle. This is the main event. This is the battle for the physical infrastructure of the 21st century.
So the new IBM strategy is simple. Own the silicon, own the server, own the cloud, own the data, and own the model. Own the entire stack.
And if you are a software company, like a Salesforce, just sitting on top of that stack, renting everything, relying on the landlord for your very existence, you are incredibly vulnerable. And that is the direct connection between the chip war and the software crash. The value is accruing to the bottom of the stack, to the hardware and the infrastructure, and it's draining out of the middle, out of the SaaS application layer.
That's the aha moment right there. The entire profit pool is moving. It's sinking deeper and deeper into the stack. So let's take all of this, the macro storm, the software crash, the chip war, and put it all together. How do we trade this week? What are the specific markers we need to be watching?
Okay, so we have to watch earnings, but not just any earnings. We need to watch what I call the bookends of the economy. On one end, we have the consumer, We get reports from Coca-Cola, KO, and McDonald's, MCD.
The ultimate are you broke indicators.
Exactly. We know the labor market is cracking. We see the high fire dynamic. Does that actually show up in McDonald's sales? Are people trading down from the combo meal to something on the dollar menu, or are they just skipping it entirely and eating at home?
Right.
If McDonald's misses on transaction volume, it tells us the low-end consumer is completely tapped out. If Coca-Cola reports that their volume is declining, it means their pricing power, their famous ability to just raise prices whenever they want, is finally gone. That would be a huge confirmation of the recessionary thesis.
Okay, and what's on the other end of the spectrum?
On the other end, we have Cisco, CSCO. Cisco makes the plumbing, the routers, the switches, the fundamental hardware of the corporate internet.
So the question is, if companies are out there buying Amazon Ultra servers and building these massive new AI data centers, are they also buying Cisco switches to connect everything?
And this is the big fear. Are they stealing budget from the networking department to pay the bill for the AI department?
Cannibalization.
It's cannibalization. If Cisco guides down, if they say enterprise spending is slowing, it tells us that traditional IT spending is being gutted to fund this new AI arms race. It helps us map the rotation of capital in real time.
So let's distill all of this down into a playbook. The listener is looking at their portfolio. They see Dow 50K on the screen, but they have this fear in their gut. What is the actual move?
The move is defensive rotation. The sentiment shift is undeniable. First, you have to avoid the expensive software and SaaS companies. Do not try to be a hero and buy the dip in Salesforce just because it looks cheap relative to where it was last year.
Don't try to catch the falling knife.
It is a value trap until we know where the bottom is on this AI disruption narrative. Do not catch falling knives.
Correct.
Instead, you see the money is flowing into real assets.
Things you can touch.
Things you can touch. Gold, real estate, commodities, things that cannot be printed by a central bank or generated by an AI out of thin air. And within the equity market, it's the infrastructure owners, the vertically integrated giants, the new IBMs. You want to own the company that sells the electricity and the shovel, not the company that is digging a hole in the completely wrong place.
Own the landlord, not the tenant. That seems to be the mantra for 2026.
It has to be, especially when the landlord is building a nuclear reactor in the basement and the tenant is about to be evicted by a robot.
That's a terrifying button.
Yeah.
A very perfect image for what's happening. Look, the Dow at 50,000, it's seductive. It really is. It makes you feel like everything is fine, like the party's going to go on forever.
It's complacency.
It is. But when you look at the yen teetering at 180, when you see the software sector melting down in real time, and you know the labor market is hiding a big problem behind a severance lag, complacency is the enemy.
Do not let the headline number fool you. The risk premium across the board is high. This is not the time to be leveraged long on hope. It is the time to be precise, to watch the data, and to respect the trend.
We will be watching that jobs number like a hawk on Wednesday and the CPI on Friday. If the data breaks, we will be back to break it all down for you.
Stay sharp and don't trade blind.
Thanks for listening to Theta Fuse.
Theta Fuse is for educational purposes only. This is not financial advice. Do your own due diligence.